Hey guys, Bobby Brandon here, Intercoastal Realty, continuing our series, Thought You'd Like to Know. Today we're up at UNCW, my old alma mater, good old school, Cameron School of Business. Adam Jones, Associate Professor of Economics and also the Department Chair of Econ and Finance.
Yep.
Adam, thanks for being here.
Thanks for having me.
Let's get into it. We've been seeing that the feds are raising the rates. You keep seeing that. Feds are raising the rates. The feds is the Federal Reserve, correct?
Federal Reserve is Central Bank of the U.S.
Okay.
Not Congress, not the President. It's an independent entity that's supposed to focus on the economy, not politics.
Okay. And when they raise the rates, what are these rates they're talking about, and how does that work?
Yeah, so the Federal Reserve has what we call a dual mandate:
Okay.
stable prices and maximum employment. The economy is doing pretty well on the employment side right now, but prices are increasing. If you haven't filled up your car with gas lately, you'll notice that at some point. So the Federal Reserve is trying to get inflation back to about 2%. And the way they do that is by adjusting interest rates to tamp down demand.
So these rates, when they raise the rates, the federal funds rates, these rates are what banks charge each other, is that correct?
Right, the federal funds rate is the rate that banks lend to each other.
Okay.
And if the Fed increases that rate, it likely increases other rates like mortgage rates, the rates on auto loans, credit cards, etc.
So the bank just takes their increased costs and just passes it on to the
Passes it on us. Yep.
Gotcha. So right now, you mentioned about the inflation going to 2. Where is it right now?
The most recent read is that inflation is 8.5%. So
That's
that means
where it is
prices
now.
are 8.5% higher now than a year ago.
In a year.
That's a lot more than 2%.
Okay. And the Fed's goal is to take it from 8.5 back down
Back
to 2?
down to 2. And the way they do that is by raising interest rates.
Gotcha. So that's a big change, 8.5 to 2.
That's a big change.
So it's pretty safe to say changes are still going to happen. The Fed's doing their thing to try to get it under control. So it's safe to say that we can expect mortgage rates to more than likely keep increasing.
As long as inflation is high, I would expect to see interest rates, including mortgage rates, increase.
Okay, there you go. Okay. We sort of know what to expect. Adam, thank you.
Thank you.
I appreciate it, buddy. Thought you'd like to know.